I do believe that this is exactly what we're seeing right now. Not that many people buying at 3,500, but boy, they're going to get in line when there's an emergency, and gold is going past $5,000 and $10,000 an ounce.
Mm-hmm. My view is it's a good time to already own gold and silver and platinum. I'm not sure it's a good time to buy it. And I wouldn't be surprised to see a substantial setback in the price of precious metals.
What Don Durrett and I talk about, though, is that 50 is not really the target here. 50 is an old target, given that you have to inflation adjust, and that would get you closer to 68 to 70 an ounce. So that's really our target for next year. We think 50 could be achieved by, say, January. And believe me, if the Fed is more dovish, that will be accelerated, right? So silver's looking great.
Gold and silver remain at the center of financial debate as investors weigh historic debt burdens, rising geopolitical risks, and the erosion of fiat credibility. While some view precious metals as having already rallied substantially, others believe we are still in the early stages of a far larger move. The pressures of a debt-based monetary system, combined with aggressive fiscal and economic policies, suggest that real money, tangible assets like gold and silver, will be the lifeboat when confidence in paper assets fades. History shows that the crowd often waits too long, rushing in only when prices reach extremes, leaving patient accumulators positioned to benefit most. MikeMaloney, an educator and author known for his profound insights into monetary history and cycles, emphasizes the importance of owning metals before the crowd wakes up. Dr. Marc Faber, an economist and investor, offers a global perspective, highlighting how U.S. policies have drawn nations like China, Russia, and India closer together, reshaping geopolitics in ways that undermine the dominance of the U.S. dollar. JohnFeneck, market strategist, adds the investment lens, noting both the opportunity and volatility within mining and metals markets. Together, these perspectives underline the same truth. The debt cycle is unsustainable, the system is fragile, and tangible assets will outlast political promises. For long-term wealth preservation, waiting for cheaper entry points may prove costly if global events accelerate the next leg higher. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Is ever since we introduced the Federal Reserve System and debt-based currency instead of using money, each time we have a war, we go deeply into debt, but then we pay it down. However, when we get down near the bottom there, those troughs, each one of those troughs, those lows, is higher than the last. It keeps on marching forward. Part of this is just the math of how a debt-based system works. You can't pay off the national debt because if you do, all of the currency vanishes. There isn't any. And so we live under a system that is ultimately impossible. And there's only one way out of this, really. It's default, but there's, default for the government. For the individual, how do you escape this? So
you hold real money. You hold real assets. You get out of dollars as quickly as you can, and you hold gold and silver.
Yep.
Just like this. That's our meme of the day.
Yeah. When I started down this road, gold was $315 an ounce when I first started buying, and I would recommend it to people. And then I'm doing these big conventions, the Learning Annex Real Estate Expos with Robert Kiyosaki, and I'm speaking to 10,000 people, 20,000 people, 30,000 people at a time. And people would ask me, but they really didn't want to buy then. And I look at them. If they say, yeah, but I want to stick in real estate right now, or I want to, it's 2004, 5, and 6. Yeah, but I want to, real estate never goes down. It always goes up. And I'd look at them and I'd say, you look like, I would say it to myself. I'd be thinking, you look like a $5,000 guy. Oh, no, you're going to wait until it's $2,000 an ounce. You're going to wait until it's $5,000 an ounce. And then, we had the global financial crisis and gold pulled back to $700. And people could have bought at those prices. And so many people didn't. So everybody watching this video has to ask themselves, am I a $3,500 guy and I'm going to buy today? Or am I going to wait until gold is 5,000? Or wait for the herd to rush in at 10,000? And
Absolutely.
so right now, what we are seeing is very, very few people buying, except for big smart money or early currency, we should say, instead of smart money, because it's not, they're changing their currency into money. So yes, I do believe that this is exactly what we're seeing right now. Not that many people buying at 3,500, but boy, they're going to get in line when there's an emergency, and gold is going past $5,000 and $10,000 an ounce.
It's not easy to predict the movement of precious metals at this point, because gold and silver have gone up quite a lot. I don't think that they're expensive yet, but there is a fair amount of speculation in gold and silver. I think that Trump is a complete ignoramus in geopolitical matters. I mean, he managed to essentially do what nobody else has been doing in the last 100 years, and that is to unite not only China and Russia, but also India.
Right.
You have to really the Chinese government and the Russian government closer together. That is unbelievable. That somehow it took Mr. Trump to achieve this. If India, China, Russia, all these countries kind of unite and are driven into a union, into a BRICS alliance, I think that is an achievement by itself. I mean, I'm not saying that Trump is completely wrong, but I think that it's wrong for the Americans to put together an alliance of BRICS countries against America. That is what I wanted to say before. My view is that for the first time in my life, I actually agree with the Federal Reserve Board because I don't think they should cut rates, but they will cut rates because they're forced to cut. Now also Besant wants to cut rates and so forth. I don't think it's a wise movement to push interest rates down at this point, because the interest rates is not particularly high. If you look at the rate of inflation and the rate of consumer price increases and so forth, then I think that the increase in prices is relatively high, and that this will have a negative impact on consumer price indices.
Mm-hmm. What are your
I think, to be fair to Powell, and believe me, I have no sympathy for the Fed. To be fair to him, he probably does the right thing by not cutting rates right away. My impression is that consumer price indices published by the government indicate inflation to be much lower than inflation is indeed. In other words, inflation is higher than what the government is publishing. Trump, given his character, will do everything he can to kind of wash the debt away.
Right.
But I think, quite frankly, investors in US treasuries will be very careful about buying treasuries, and anything that is related to cryptocurrencies. So to answer your question, I think that this idea that cryptocurrencies will replace the government debt is a complete joke. My view is it's a good time to already own gold and silver and platinum. I'm not sure it's a good time to buy it. And I wouldn't be surprised to see a substantial setback in the price of precious metals. No market has gone up consistently without corrections.
Absolutely.
So I think, yes, there will be corrections. But I think the bull market is still on, and it could last. The bull market in gold could last another few years.
Rate cuts are firmly on the horizon, and markets have already begun pricing them in. A modest 25 basis point adjustment may be expected, but the real impact lies in how far and how fast monetary policy shifts into 2026. Precious metals have responded favorably, with silver pushing against resistance levels near $42 to $43, and momentum suggesting a potential move toward $50 in the near term and $68 to $70 longer term once adjusted for inflation. Silver equities, particularly mid-tier miners, are showing explosive upside, with sector ETFs already advancing close to triple-digit gains this year. At the same time, financing structures in the mining space have created both volatility and opportunity, leaving several undervalued producers trading well below their intrinsic worth. This environment highlights a generational window for capital rotation, where the right strategies could capture outsized returns as the metals bull market accelerates. Let's get back to the interview.
Rate cuts are going to be implemented starting September 17th, no question. However, how big is that, and what is the path for the Fed going forward is really the question investors need to be asking. A 25 basis point cut is already baked into the broad market as well as gold and silver. If we get more than that, that would be bullish. If we get Powell to show us a path to 2026, that would be bullish. Remember, Jesse, last year around this time, we were all talking 4 rate cuts for 2025. I was on your show, right? We talked about that. Then in December, after the Fed meeting, it became 3 rate cuts, and people were like, okay, that's fine. But then it became 2 rate cuts pretty quick, and now we're looking at 1 or 2 between now and the end of the year. So I think that rate cuts obviously are going to be bullish for the broad market, bullish for gold and silver, but I would argue that the broad market is, as Steph Pomboy says, just floating on air. Like the broad market has rallied since March of 2009. My message to investors is look at your 401k statement over the last 15 and a half years and ask yourself a tough question, which is, was this my expertise, or is this partially luck or all luck, right? I mean, you have to start taking some money off the table if you're in the NASDAQ and some of these aggressive ETFs. I just cringe when I start to see some of this stuff on client statements, or when we do a phone call together, they mention this stuff and half of their net worth's in some of this stuff and they're 70 years old, right? The S&P right now is 45.41% tech as of August 31st. You do not want half of your, equity exposure in a 401k, half of that being 25%, right? If you have a 50% weighting in the SPY, in technology, at that age, right? You have to be smart about it. I have every incentive to tell you silver's going to 100. I'm not going to say that. I think at 41, you've got some resistance between 42 and 43. We keep knocking on that, and it's sort of just fluctuating right now. We have to get through that level. But honestly, after that, it's all the way to 50. What Don Durrett and I talk about, though, is that 50 is not really the target here. 50 is an old target, given that you have to inflation adjust, and that would get you closer to 68 to 70 an ounce. So that's really our target for next year. We think 50 could be achieved by, say, January. And believe me, if the Fed is more dovish, that will be accelerated, right? So silver's looking great. The silver equity ETFs are looking great. SILJ is the equivalent of GDXJ for silver miners, and it includes a lot of the mid tiers like Core, First Majestic, etc. That thing is cranking right now. It's up, I think, 80 or 90% year to date. But what's interesting is that ETF didn't start SILJ until I believe January of 2013. So you don't really have, as an investor, a way to look back and see how that thing would have performed in 2010 or 2011, right? But I'm telling you, it's going to be higher than the historic chart is. And so that's what we expect. 23 was the all-time high, I think, on SILJ roughly. And now we're over 20. So we think 23 is an easy target going into next year. If the Fed chair got taken out by Trump, you can be sure gold and silver might dip initially on margin calls. Same with GDX and J, but they would rocket higher after that because you'd have a crisis of confidence to deal with, and the broad market would tank. So, yeah, the thing is, most people are greedy, Jesse. This is more greed than 1999 into 2000, by far, in my opinion. Like, it's just time to be realistic and to look at what you have and be thankful for it. On the silver side, we just met with Aftermath Silver for lunch yesterday. Michael's really excited about his MRE. Is coming out here like in a month. And basically, he thinks he's going to put up a lot more silver than the market thinks. One of the things that's interesting, Jesse, is like the shock at lunch was when you look at his presentation deck. He's talking about silver ounces. He's not talking about silver equivalent. And that's what a lot of companies will put in their deck, the silver equivalent, which isn't cheating. It's just how they report it, right? But when you're talking about like 140 million ounces of silver plus all the copper he has, plus all the manganese, which is 99.9% battery grade, he said it's like, I mean, I don't want to throw out a number. Let's just say it's not even close to 140 million. It's over 500 million ounces of silver equivalent. So it's like it's just a huge number. And this stock's at 57 cents today. So I don't know how the market's up for gold and silver, and the stock is down today. But we bought more today in full disclosure, coming out of that meeting because Eric Sprott and him are good friends. Eric put in a lot of money into Aftermath. It's actually his third largest holding. The ticker is AAGFF and AAG in Canada. It's kind of detrimental to some of these stocks because it allows the buyer of shares to immediately sell them if they wanted to and keep the warrant, right? That is a common thing in our sector, which we don't do.
Yes.
But it really puts artificial pressure on shares. You saw this with Guanajuato Silver. They just did one for 20 million bucks, much bigger than Denarius's. And that thing was underwater until Don mentioned it on the Market Sniper, and the stock went up 25% in one day. So, I mean, like, this is like go time. You have to figure out a strategy and buy something and buy a basket of something. And that's why we kind of stressed, Jesse, that Don's services, my services are all very affordable in the context of a bull market, right? Maybe 2 years ago you couldn't justify it. If you're not aligning yourself with someone like us right now, you're making a huge mistake. This is like lifetime generational opportunity. You're not going to get the same opportunity. I don't think it lasts 10 years like Don. I think it lasts 2 years, like from here. Because if you look at the chart of GDX and J from September of 2022, that was the bottom, right? It wasn't this year. It bottomed there. So like you're looking at already a 3-year run, which a lot of people miss. So yeah, Denarius Metals, they were talking about this at dinner. They were saying, look, we got bombed out. Like we lost, 25% of our market cap because we did one of these financings. And I put out a note to my followers. I have a real-time email service after I got off the phone with the chairman. And I just said, hey guys, like this is artificially low. There's nothing wrong here. We should be putting a position on into something like this that just went into production. Don and I pointed out on stage here as well, there's less than 200 producing miners, and Denarius is one of them. So how is this thing trading at 37 cents as we record this? Like that's the opportunity. That's like worth, probably 50 to 60 cents by accident by year end, right? Like that's just, we don't always go for the home runs, Jesse. Don's more like the home run guy. He's calculating 5,000 gold and $100 silver into all of his comments when you do hear him talk. And I'm always just looking at the near term, right? I'm looking at 3, 6, 12 months. How can this develop? Because I find that most high net worth clients they don't have patience. They're not going to sit around and wait for 3 years for something to work. especially when tech is doing what it's doing and Bitcoin's doing what it's doing and real estate's doing what it's doing. There's too many opportunities.
The global financial system is moving deeper into uncharted territory. After years of manipulated interest rates and relentless monetary expansion, the distortions are now embedded across markets. The cracks that appear in equities, bonds, or currencies are all symptoms of the same underlying issue, the erosion of money itself. Precious metals, on the other hand, remain a timeless store of value, consistently proving their role as a hedge when faith in central policy wanes. Each cycle reinforces the same lesson. While paper assets may soar and collapse, gold and silver endure. The challenge for investors is not recognizing this truth after the fact, but positioning ahead of the turning point. The coming years will test portfolios more than the past decade of easy money ever did. Staying grounded in tangible assets may be the most critical decision of this era. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.